Hello and welcome back to Dukascopy TV. Now, gold, a topic which splits the financial community, perhaps none more so than our debate panel today. We've got bulls to my right with David Smith and bears on my left with John Hancock. Gentlemen, thank you very much for coming in today.
It's a pleasure. Thank you.
Now, David, I'm going to come to you first. We have seen a slight rebound in gold prices since the two-year lows of April. What is it that's currently driving gold on the positive? And conversely, when we come to you, John, what is it that gold optimists are missing in terms of risk?
Well, I think to look at the gold situation, you have to wind the clock back a little bit more than 2 weeks. If we've seen what's happened over the last 10 years, gold has come up many times from 300 or 400 to 1600 and peaking at 1900. Now we're at 80% of that as a price, which is not of itself too bad. However, if you look at what's happening over the last few weeks and months, the price has been capped by regular intervention by market forces, namely the Federal Reserve and the American banks are beating the price of gold down on a day-to-day basis. Now, normally speaking, this just slows the rise, but in fact what has happened recently, and probably as a sign of desperation on the part of these banks, is that they have decided to make a massive beatdown on gold, and in order to achieve it, they had to sell in a period of approximately 1 hour 6 months of gold production for the world in 1 year. So if you do that, obviously, you are not doing it to sell at the best possible terms and conditions. You're doing it deliberately to beat the price down, which is completely systematically ignored by the American regulator, the CFTC, and has been for many years, despite numerous attempts to make them face up to the fact the market is rigged. So what happens when you beat the price down? You start triggering stop-loss positions of people who thought the price would not fall below a certain floor. They sell, and the whole market cascades down. And if you do it violently enough, you can get a 10 or 20% drop, which is what they have very proudly achieved. However, I think the problem this time is that the real reasons that they have been doing this is because they are running out of physical gold to deliver. And they were hoping that by driving the prices down, they would drive people out of the market who would then not ask for gold. And in fact, what has happened is exactly the reverse. There has been a very high demand for physical gold throughout the world. We're now in the season in India, in particular, it's the gold season. China is a major importer. The central banks are major buyers looking for dips in the price. And we've now just seen the situation in Japan, where the price of gold priced in yen, which has been depreciating dramatically, is seeing all-time highs. And if you take the point of view of any sensible Japanese investor, looking at the fact that the government has decided to destroy deliberately the value of their currency, gold is a very attractive option. So I think this attempt at manipulation has backfired. I think that the inventories that are reported as actually existing in physical gold do not exist, either in the central banks or in the warehouses of the likes of the LBMA or the CME in Chicago. And at the end of the day, we could be moving towards a complete breakdown in physical delivery of gold. There are indications of this already by the fact that ABN AMRO, for example, is now refusing to deliver physical gold and only paying out in cash. And it's even said that a certain Swiss bank has argued that gold could no longer be delivered because it was against the money laundering regulations of Switzerland, which of course is a complete stack of lies. So I think the situation in gold is becoming very interesting. The rebound that we have seen from a beatdown like this, it has recovered about 60% of the value in less than 2 weeks. And I think for the future, people are realizing that the paper gold market is rigged, as are many other markets, including LIBOR, including interest rates, including currencies, and the list can go on and on. But certainly the barometer, which measures value, which is theoretically gold, is an independent measure of value. They've done everything to try and put the lights out on this, and unfortunately it's not worked for them.
So that's the word from our bull. Now, John, what are the pressures then on gold?
Yeah, I think, I have to disagree with David on this. I think in the short term we've seen a rebound, but in the long term I think there's going to be downward pressure on gold. And I mean, it's treated as a real asset in a world of bubble economies or of artificial or volatile prices. Gold itself has become a volatile asset. I mean, I totally agree with you. I think the market is not as transparent or as stable as people would like to believe. And this bubble territory has thrived in an atmosphere of negativity. This gloom and doom we've experienced about the global economy and in particular advanced economies lasting since the financial crisis in 2008. I mean, first of all, gold's meant to be a hedge against inflation, and the gold bug said, the inflation's coming, the Fed's printing money, Bank of England's printing money, now Japan's printing money, it's coming. Governments are borrowing like drunken sailors. The inflation hasn't come. We've waited, but it hasn't come. In fact, if you're in Japan's finance ministry or central bank, and even in the US, the concern is deflation. Gold's also a safe haven in bad economic times. And again, we've waited for the other foot to fall. We had the financial crisis, we had the Great Recession, but we were warned by the gloom and doom prognosticators that we were about to fall over another cliff. It was going to be a big crisis. The big crisis hasn't come. I mean, in fact, in the United States right now, there are tentative signs of a recovery. Not a spectacular recovery, but a recovery. Housing market's improving. GDP numbers are up, 2.5% GDP growth. Not spectacular, but it's something. We have exports up, manufacturing sector's reviving, and inflation is low. Meanwhile, corporations are making huge profits. I suspect that some of the money that isn't going into housing now will find its way into equities. So I'm not convinced that gold is the safe haven if it was over the last 5 years.
Great opening comments there from both of our guests. To hear more from this debate, click back for part 2.